on the disadvantages side of things, so be mindful that when you are using your superannuation monies to fund your insurance, be mindful that you're eroding your retirement savings. So you need to really think about strategies and how to mitigate those down the track, right? So, because as you can imagine, if you take $1,000 out of your super fund to fund that premium, be mindful that's $1,000 coming out of your retirement. So you really want to think of strategies and how you can mitigate that over the long term, because otherwise it's going to leave you with less money at retirement. You also need to bear in mind, when your policy is sitting inside superannuation, you're actually sitting in a different environment. So for you to have a successful claim to be paid that money to you personally, you need to meet both your policy terms and conditions of that particular insurance policy, as well as an SIS condition of release, okay, before that money will actually get paid to you. Because if you don't meet that second hurdle, the condition of SIS condition of release, what can potentially happen is you meet the policy terms and conditions and it gets caught up in your super fund. The other thing to bear in mind is that some of our built-in benefits are going to be lost. So a lot of those policies that offer additional built-in benefits when you hold the policy personally, so your funeral advancement cover, your partial TPD or accommodation benefit, things like that, you might not be able to have, typically speaking, when you are funding this through your superannuation. So be mindful of that. You are missing out on some of those benefits as opposed to if you had them personally owned. The other one to also bear in mind, another disadvantage, if you are looking to fund your income protection through your super fund, typically speaking, your income protection premiums, when it's held in your personal name, is tax deductible at your marginal tax rate. If you are insured and you're the person paying for it in your personal name. However, if it's in a superannuation environment, you're only going to be able to claim, or your super fund's only going to be able to claim 15% of those premiums back as the tax deduction to the super fund. So typically speaking, that 15% is going to be a lot lower than a normal working Australian tax deductibility rate if you held it in your personal name. Here again, you also have that double layer situation with income protection as well. So just be mindful of those funds before considering whether you should or shouldn't be funding your insurance through your super.